2021 year-end update. My name is Cameron Smith. I'm the Vice President of Advisory Services here at Nicola Wealth, and I will be your host for today. I'm actually filling in for Ethan Astenay, who is our regular host for these semi-annual updates. But in a sign of the times, Ethan is currently recovering from COVID. Thankfully, I've checked in with him this morning, and he's already starting to feel better. Some quick housekeeping before we get started. You will notice we're using a new platform today. If you wish to add subtitles to this video, you can do so by clicking the small CC button below our live video stream. If you have any questions about the platform or need any assistance, please use the Ask a Question button to connect with our team. We want to leave time at the end of our discussion for questions from you, our audience. If you would like to submit a question, you can do so by using that same Ask a Question button. We will be recording today's webinar, and a link will be provided through email to anyone who has registered. And now, with no further delay, I'm really excited for today's discussion with Mark Hanna. Mark is the Managing Director of Real Estate here at Nicola Wealth, and he's a founding member of the Real Estate Division, which formed in 2003. Mark has extensive commercial real estate experience across North America, and we're very happy to have him. So thank you, Mark, for joining us today.
Thanks, Cam. You're filling in for some big shoes.
Ethan is as much a part of this as you, for sure. So going to jump right in the interest of time. We have lots of ground to cover, and again, we want to leave some time at the end for questions. So just jump in with a very open-ended question. Can you start us off with an overview of 2021 year-end results, and what are your forward-looking projections for 2022?
Sure, thank you. So the quarterly fourth quarter statements were recently distributed by email to all our clients, and the year-end returns for all three of our Nicola Wealth Real Estate funds, they're shown on the screen. So let me touch on all three funds, and I'll start with the Nicola Canadian Real Estate Income LP. It recorded 18.4% return for 2021. This is a fantastic result, and it more than makes up for the previous year when the outbreak of COVID in March 2020 impacted returns on a global basis. So last year we added 19 acquisitions. There are a number of factors for the strong performance. Firstly, our fund composition for multifamily, apartments, self-storage, flex/creative office, and industrial properties in key growth markets such as Vancouver and Toronto, they really paid off for us. Secondly, our Nicola Wealth Real Estate team was able to achieve some outstanding outcomes with rental income growth, specifically for our self-storage and our industrial assets. I must admit that even we were shocked at the rapid escalation of rental rates for industrial assets. And lastly, cap rates compressed for all of these asset classes. And these factors all contributed to this impressive result. So looking forward for this fund, we will continue with our strategy on fund composition in the key markets. Our conservative projection for returns in 2022 is in that 10 to 11% range, which is essentially mirrors our 5-year average or since inception. Moving on to the Nicola US Real Estate LP, it recorded an 11.5% return for 2021. This is a very respectable result. Last year, we added 17 new acquisitions. The revenue growth and valuation increases for our multifamily rental apartment portfolio in our partnership with Venterra, it really kicked in during the last half of 2021. To complement the strategy, we have been aggressively acquiring and building new small to mid-bay industrial distribution product in markets such as Phoenix, Denver, Vegas, Dallas, Seattle, and now Minneapolis. Similar to our Canadian Income Fund, this strategy is paying big dividends as we are benefiting from strong tenant demand from industrial users in these markets. We're also building a self-storage portfolio in the US, starting in Denver, similar to our advanced self-storage portfolio in our Canadian fund. So looking forward for the US fund, we will continue with our strategy on multifamily with our partner Venterra, and with our pursuit of existing and new build-to-own industrial product in the target markets. Our conservative projection for returns in 2022 is also similar to the Canadian fund. It's in that 10 to 11% range, which is consistent with our returns since inception. And last but not least, our value add, Nicola Value Add Real Estate LP, it recorded a 12.9% return for 2021. This is also a very respectable result. 2021 was really active for this fund as we added 31 new acquisitions. As at year end 2021, we had 62 projects for a total AUM, assets under management, of 650 million. And we had another 12 acquisitions that we had under contract that carried over into 2021 and will close in the first quarter. We have added some new strategic partners as well for this fund, and we are very excited about that. We also have several existing reliable partners who we are scaling up with on new projects. So looking forward for the Value Add Fund, we've built a great stable of quality partners to help us execute on this fund. There are several key markets that we've had success with, and we will continue. We've had strong results with certain asset types such as small bay industrial condo, multifamily rental apartment buildings, land entitlement, and residential condo, just to name a few. Our conservative projection for returns in 2022 for the Value Add Fund is more optimistic, as we are targeting in that 13 to 15% range, which is above our 5-year average.
Thanks, Mark. One of the things you were speaking about in that update was acquisitions. It's been a very active year for you and your team. Can you comment on our current strategy looking forward as it relates to real estate asset types and specific markets geographically that you're targeting?
Sure. 2021 was just an insane year. It was crazy for our team. We completed 1.9 billion in transactions, and we had another 400 million that we put under contract and is scheduled to close in Q1 2022. So that's probably 3 times the normal volume for our high water mark. Fund composition is really important. And this was highlighted during COVID, where rent collection really exposed real estate like never before. So this is why fund composition matters. It needs to be durable during these challenging environments, which will come again. The liquidity of assets has a big impact on property valuations, and the leasability of assets is critical to maintaining high occupancy and rent collection. The asset types that are in high demand, everybody's read about these, is multifamily rental apartment buildings and industrial, but also self-storage. Really, we've made a big bet on that, and that's paying off. And then flex / creative office, which is kind of single story or 3 to 4 story office buildings. Those assets all command a premium. And this is why we're developing these assets in our income funds under our build to own program, which generate favorable returns once they're completed and stabilized. The asset types that we're staying clear of, or we're being really cautious of, are hotels. We don't have any, and certain retail, such as, say, enclosed shopping centers. High-rise office assets, we don't have any. This type is interesting. Return to work is still unfolding for many companies, as we are seeing the adoption of hybrid working environments, providing more flexibility on work-life balance for employees. Notwithstanding, high-rise office assets actually have defied logic, where tenants continue to pay rent even though their staff have not fully returned to work. This has been going on for 2 years. In fact, some cities such as Vancouver and Toronto are actually flourishing, as their vacancy rates are actually declining as the last remaining large companies gear up for the return. So geography is a very important consideration. We have been strategic in selecting certain markets for that cluster strategy that feature low vacancy rates, strong employment growth, and favorable tax environment. In Canada, we've built strong positions in major markets such as Vancouver and Toronto, and as of late, Montreal. And that's in addition to certain strong secondary markets that we like a lot, such as Victoria and Kelowna. So going forward, we're going to continue to focus on the assets that have performed well for us on rent collection, such as multifamily, industrial, flex office, and self-storage. However, there may be opportunities with stressed assets, such as certain retail, that we might consider in the future. Another strategy that we've adopted over the past several years is acquiring covered land plays in both Canada and the US. And the covered land play is where there are existing uses on the property that provides attractive holding income in the short to medium term, but there is a higher calling and next generation for that property. So typically these might include a transit-orientated site, or it could be a well-positioned industrial property in a strong node. And this has helped us build up a large inventory of future development sites while benefiting from holding income until we plan for the next evolution of that property. So on this slide here, we've got a few examples, and just going from sort of left to right here, we've got in Minneapolis, we bought a very large industrial property portfolio comprising 22 buildings. It was $230 million, and it was a great entry into that market. We did a lot of research on that market, and we liked how many Fortune 500 companies were there. We loved the low vacancy rate. There was just a lot of attractive features to going into that market. So right out of the gate, we've been able to get some great wins on renewals and revenue growth. Going across from left to right in the middle, AMPAC 1 and 2. This is in Henderson, Las Vegas. We have 4 buildings, plus we have some surplus land where we can put into development. So we very much like the Vegas market. The vacancy rate for industrial is very low. Northgate Executive Center in Seattle, right off the I-5. It's right across the street from the transit station, and Seattle is just starting to really kick in on the benefits of having transit that's going to go north-south from this location down to SeaTac and east-west going out to Bellevue and Redmond. So we like this site. It's a 7-acre site. It's got 3 buildings, but we can build up to 2 million square feet. So we're certainly starting to look at how we can plan in multifamily product to complement the office on that site. Down to the bottom is Spur. This is in Dallas. This is our first acquisition. This is a 17-acre site that we're very excited about. It's a first foray into the Dallas market. Dallas market reminds me very much of the Toronto market 3 years ago, where vacancy rate's low, demand is high, and rental rates are low. So this is just the first of many that we envision with our cluster strategy in that market. And then going in the middle and the bottom there, we've got Van Buren. We just acquired this recently in December in Phoenix. Again, there's two existing industrial buildings, plus we have a smaller one with surplus land where we can, down the road, redevelop that site into new traditional distribution. And then the last in the bottom left is Chatfield Distribution Center, which is in Denver. That's another market we like a lot, and this is a multi-tenant industrial property.
Just before this call, as we were getting ready, you were mentioning that the time you've spent in the U.S. and the time you'll probably continue to spend in the U.S., lots of potential there, clearly. Always a credit to you and your team, Mark. You update us, the advisory team that works with our clients on a regular basis. And one of the things that you've mentioned is the marketplace within real estate now is very competitive. It's a very crowded field of investors looking to acquire properties. So what would you say is your competitive advantage?
I would say that our strategy is really to try and, I always say this, is to try and shoot or swing or target for singles and doubles that have the potential to turn into triples and home runs. While I wish I could hit like Babe Ruth, my concern is that if we do swing for the fence for a large acquisition and the acquisition underperforms, then that moves the needle in the wrong direction. So this strategy has really served us well over the years. So in 2021, real estate rebounded much faster than anybody anticipated. And you're correct that the playing field of capital is very strong and uber competitive. Properties that are listed for sale are typically underwritten to perfection by brokers, and in most cases, probably better suited for pension funds and institutional buyers who are typically not capable of doing the heavy lifting like our team can do. We still, from time to time, acquire listed properties, but we're very disciplined, and quite often we will tap out of these bidding processes as the pricing gets silly. So instead, our Nicola Wealth Real Estate team, we work hard at sourcing deals off market, and we think that gives us a competitive advantage. This strategy is where we excel, and we complete a majority of our acquisitions through the off market strategy. It's interesting how things have changed so much for us over the last number of years. So 3 years ago, I would say that we had more capital than deals. And you fast forward to today, it is now the reverse, where we have the luxury of more deals to consider than capital. And this allows us to be even more selective and deliberate in our growth. A big reason for this trend is really a direct result of our increased profile, and it's stemming from the high acquisition volume that has happened over the last 2 or 3 years. This is complemented by our frequent press releases on acquisitions, enabling us to reach our target audience, which is the brokers, who are the source of these off-market transactions. So we rely heavily on the brokerage community. We want to treat them fairly so that they think of us first when they have that opportunity. Another recent interesting trend that we are experiencing is where sellers are now approaching us directly to transact.
Lots of news. Thanks for that, Mark. Lots of news, even just in the last 24 hours, around interest rates, around inflation, and the fact that the threat of rising interest rates is pretty imminent. I can see questions starting to flow in already, and there are several focused in this area. What impact may there be on returns if we do see rising interest rates, and how is your team preparing to adjust your strategy?
Yeah, I think everybody's been preparing for interest rates. They knew they had to go up eventually, so it's not a big surprise. So in 2021, our 3 Nicola Wealth Real Estate funds, they benefited from 2 major contributing factors, being net income growth and cap rate compression, meaning that the values went up because of the yields. So there's no doubt that interest rates influence cap rates, and they play a very important role in the psychology and in the pricing guidance by the brokers on behalf of sellers. So I'm not an economist, but interest rates, they need to rise and go up so that the Bank of Canada and the US Federal Reserve, they have room to stimulate the economy in the future when the next event happens by lowering rates for the next economic downturn. And that will come, no doubt, at some point. It could be 2 years, could be 5 years. We don't know, and we don't know what it's going to look like. But this will help also temper inflation, which is at concerning levels. In terms of investment strategy, our Nicola Wealth Real Estate team, we're remaining very disciplined with our criteria, and that includes investing in key major markets and concentrating on assets in strong nodes in that particular city. And so, quite often when a property is brought up to the group for discussion, my very first question is it in a strong node? That's the number one thing I look at within that city. And if the answer is no, we move on to the next. We also look for assets with good bones, meaning they offer good utility and it's not too specific for that tenant. Most importantly, we focus on properties where the in-place rents are at or below market, so that allows our very skilled in-house leasing and asset management team to work their magic and grow that income. So you can see as I go through this, Cam, I'm ticking boxes as we look in my head on these when these opportunities come up to see if they meet our criteria. So if we can execute on this strategy and grow revenue with built-in annual growth, rental growth, this serves as a great counterbalance to rising interest rates where cap rates might be influenced to trend up. So our team is not scared of rising interest rates. The market is often slow to adjust and may have limited impact due to the surplus of capital looking to be deployed. Some of our investors may remember that when we started our first acquisitions to launch our funds back in 2003, cap rates were 8 to 9% and interest rates were 6%. The common theme is that there was typically a spread of 2 to 3% between interest rates and cap rates, and that still exists today. It's just that the dynamics are different. The bottom line is that we have an experienced team that can make adjustments on the fly to changing environments and still achieve favorable outcomes for our clients.
Great to hear the strategy. Inflation, potential for rising interest rates is a discussion that comes up in the majority of our client meetings at this point in time. And to hear about your strategic approach, I think is empowering for advisors and for our clients. You've given some really strong updates in all three of our funds. And if we combine the value of all three of those funds together, it's now exceeding $6 billion in gross asset value. So how important is it? That's a significant amount of capital. How important is it to have the right team managing such a large portfolio?
I remember talking to John Nicola about our business plan to try to grow it at 10 billion total asset value, and that was only a couple of years ago, and I thought that might take 7 or 8 years, and I can't believe how close we are to that now. So the growth we've experienced over the past few years, we've surpassed that $6 billion total asset value. It's truly amazing. And, real estate does not run on its own. Our secret sauce is absolutely our people, and they deserve all the credit. They've worked incredibly hard over the last 2 years during COVID, working in the office every day, collaborating to achieve good outcomes for our investors. Our team is growing fast. We're now up to 55 people on our team and growing. Most of them are based here in Vancouver in our office. We do have a couple in Toronto. We have one in Seattle, and it's growing as our funds grow. They're very experienced. They're highly dedicated. They're passionate at getting the right outcomes for our investors. And I often say to them, every win matters. No matter how small, they matter. And those 1,000 wins that we get during the year, they all add up to a good result. I'm also proud that we've implemented really good systems and processes that allows our team to scale up and reach our BHAG target of 10 billion total asset value. And just given the sheer size of our three real estate funds, our team is faced with multiple decisions on a daily basis, whether it's leasing or mortgages or development. And it's critical that we have that strong communication and collaboration with our team. And it's great that we can all work in the office, because having those meetings all day long together, it just makes it way more efficient. We've made some strategic additions to our team over the past couple of years, including in-house mortgage specialists for our very large portfolio. We've got leasing specialists, who I mentioned earlier, to help keep our portfolio leased and grow that net income. We've got a development team now that we've built for our build-to-own assets. We've got experienced asset managers that we've added. We've also added an insurance specialist, which I'll talk about a little later. And one of the things I'm very proud of is the best-in-class asset management team for advanced self-storage, which has really taken off. Another important fact our clients or potential clients should know and take comfort in is that Nicola Wealth employees are heavily invested in our funds. We now have approximately 100 million invested just in the three real estate funds, which really promotes strong alignment with our clients. This slide on the screen here, Cam, just shows our flywheel. It's busy, but it's kind of our flywheel, and it kind of summarizes everything that I talked about.
We, within the firm, you mentioned the BHAG goal. We use that term within the firm. It's called a big, hairy, audacious goal. Every department in the firm has what we would call our own flywheel and our own BHAG, and great to see the progress you're making towards yours. Curious, Mark, does your team ever sell properties in our two income funds? And if so, can you explain why, what the reasons would be for doing so? And can you give us an example or two?
Sure. So our three funds are all open-ended evergreen funds. And in particular, the income funds, they're designed to either acquire assets or build assets and keep them for a long term. Growing the net income, refinancing them, recapitalizing is a simple but proven strategy for real estate investing with a long-term investment horizon. So while we have a clear investment strategy in terms of geography and asset type, strategies and investment criteria, they can change over time. And that is no different for us. So our team undertakes a full review of the entire portfolio on a semi-annual basis. So you can imagine with over 250 properties and growing, that is a very necessary undertaking, and it takes time. In that review, we identify properties that might be suitable for disposition for various reasons, including geography, size, or asset type. And so while we don't generally sell our assets in our income funds, we do believe it is good discipline to cull the portfolio from time to time. So when determining whether to sell an asset, the question I often ask our group is, would we buy that asset today, regardless of price? Would we buy it, whether it's the asset type, the geography, or what have you? If the answer is no, and we can sell the asset at or above our NAV, we will execute on that disposition strategy. So on the slide here, these are 5 transactions that we completed, dispositions that we completed in 2021, and each one has a story. So with the first one at the top, going from left and then going clockwise, Lougheed Supercenter, this is a great retail center. It actually performed very well, even during COVID, but we're not really pursuing retail assets. So when we were approached off market to sell the asset and it was above our NAV, we said yes, because we wouldn't buy that asset today. We're not pursuing those types of assets. In the middle, going clockwise, Plaza 400, this is an office building in Prince George that is, we bought from the BC government on a sale leaseback. So it still had a long-term lease in place to offer the next buyer. But the reason we sold is because we have decided that we're not going to be acquiring additional assets in that marketplace. So to have a one-off asset didn't make sense for us when we have other priorities. And again, we sold that. We did list that, and we sold it to a buyer who also is now going to enjoy another nine years of income from the BC government, which is great to have that covenant because you know you're always going to get your rent. Keep going clockwise, Cathedral Energy Building. This is in Edmonton, in Nisku. This is a very small asset, so it's more the size why we sold this as opposed to Edmonton. We still like Edmonton. It was just a small property. And then down on the bottom, Canyon Park Heights. This is in a suburb of Seattle, Bothell. This had a healthcare tenant. We had listed at one point, took it off the market, and then we received an unsolicited offer, again, at a price higher than our NAV. And the reason we were okay to sell it is because the dominant tenant, being Molina, was only prepared to commit to 3-year terms, and we didn't like that exposure. And then the last one in the bottom left is South Hill Village. Again, this is a retail asset, but all 4 tenants have remained in place since inception, since we acquired the property. And but we're not buying retail. We're not buying this type of retail. So we did receive an unsolicited offer at above our NAV. So again, we asked the question, would we buy this asset today? We said no. We sold it, and it was a very good outcome. So those are the 5 dispositions that occurred in 2021.
Selling of properties at a strategic, focused time obviously can help drive returns. Another big aspect to performance is cash flow from the properties. Can you explain how important your leasing strategy is to securing that cash flow?
Sure. Everybody's heard the term cash flow is king. So that's absolutely true. And leasing is very important. Keeping the assets leased is priority number 1. It's critical to have quality tenant covenants and properly structured leases that have ideally built-in rental growth to counterbalance the anticipation of rising interest rates and cap rates in the future. We made a strategic decision to hire 2 highly skilled leasing specialists who work closely with our asset managers, and they've made a material difference in the outcomes. Tenant retention, as I've said, is a primary focus, and it's really critical to our fund returns. We view our tenants as our partners. they know the asset better than us because they work there every day. We want our tenants to succeed. We know that our tenants want the buildings maintained well, and we make sure that we know them and stay in close contact. And that's why asset management needs to be better than just average. Working with the real estate brokerage community is also important as we strive to treat them with respect and pay them fairly on lease transactions. We don't like vacancy, but we're not afraid of vacancy, as we're confident that the assets we acquire, they're actually located in strong geographic nodes, and they'll appeal to a wide range of users that should attract strong interest. And I'm very confident our team can execute. We specifically target properties to acquire with quality tenants where our team can shine and grow the revenue.
Mark, your team continues to develop what we call build-to-own properties for our income funds. Can you explain and touch on why this is important?
We made this decision a few years ago. It's really difficult to acquire new and shiny product at retail pricing and make those acquisitions accretive and complementary to our fund returns for our investors. So that's why we made the decision about 4 years ago that we need to do build-to-own assets for our income funds. So in order to do that, we set out to assemble an in-house development team to execute on that strategy. Build-to-own allows our team to create value, provided that you build the right assets, the preferred assets, in a premier location. You can't replicate those same returns if you buy new and shiny at retail pricing. So the types of preferred assets we are building, no surprise, are multifamily rental apartment buildings, self-storage under our advanced self-storage brand, industrial distribution buildings, and single-story or 3 to 4 story creative office buildings. And as mentioned earlier, we've built up an impressive inventory of future development sites through our covered land play strategy that will provide a nice large pipeline for us for the years to come. With this strategy, we now have accumulated a large land inventory for our development pipeline, but with the added benefit of strong holding income while we plan for the next evolution of those properties. So on this slide here for the build-to-own projects, I'll just maybe go through a few of these. Again, going clockwise, starting in top left. The Spencer Block in Victoria, this is now under construction. This is a new rental apartment building in the heart of downtown Victoria. In the middle, Mackenzie and Shelburne. This is also in Victoria, only blocks from University of Victoria, and our team is just in the final stages of getting permits, approvals, and we should have a shovel in the ground to build this very impressive multifamily apartment building with some service retail at grade level. And then in the far right, we've got Cambion 7th. It's the Robinson Lighting property for those who are from Vancouver. And this is going to be the new home of Nicola Wealth Real Estate for their head office. And there might be other tenants. We're looking closely at doing mass timber. Haven't made that final decision, but we're in the process of dealing with the final permits and design, and hopefully we'll be able to start construction on this soon. Down on the bottom right, Evenhead, we're very proud of this building. This is in Mississauga. This is just under a 300,000 square foot beautiful industrial building. We had it was completed in May of last year. We had, just to show you how strong the market is, we had 4 tenants, each who wanted the entire building, logistics tenants. We ended up staying a bit patient, and we were lucky enough to secure Amazon for a 10-year lease with annual bumps. So we're very proud of that building. And then in the middle and the bottom, we've got Spears Road. We did a sale leaseback with Mancor, so we can build 2 new distribution buildings now. We already have, again, just to show how strong the industrial market is in Toronto, we already have offers for all this space, and we haven't even started construction. And then the other building, which is older, there's a lease back with that owner, and we'll get to that property in the next 3 to 5 years. And then in the bottom left is Milner. It's a very large 20-acre site that we bought in Scarborough in Toronto. We got this at a very good land price. and we're in for planning now and to build another 350,000 square feet of quality industrial distribution space.
For our clients joining us from Ontario, there's interesting to see there's a reasonable chance that as they order packages from Amazon, it may have passed through one of our properties. Value Add Fund is now 7 years old and has over 70 properties in the portfolio. How has the strategy evolved with respect to our real estate partners who you've mentioned before, and as well as the asset types that we invest in and some of the market dynamics at play?
Yeah, the value add, amazing how time flies, but it's now in its 7th year, and it's really developed a solid track record, and it's very well diversified. This, for our listeners, this is really a pure merchant fund. So what that means is we either build to sell or we repurpose and sell. So while the equity multiple on these deals is an important and interesting metric, the primary focus is really the IRR, the internal rate of return, which is really time weighted. So it's a good discipline. And it's how we're measured by our investors. Therefore, time is your enemy. And if a project takes longer to complete, that has an impact on the IRR. So we want to make sure we can get projects in the ground and underway as soon as possible. The value add fund has really benefited in the earlier years from some great tailwinds. We took a lot of things for granted. And then all of a sudden in 2017, 2018, costs started rising, permits took longer. This put stress on our delivery dates and the IRR. It's challenging to acquire lands that will take 2 to 3 years to put into production due to the permit process. However, sometimes it can still work, especially if you've got holding income on the property while you get your permits approved. So our strategy over the past 2 years has adjusted slightly, where we're really focusing on developments such as small bay industrial condo, industrial mid-bay for lease, multifamily rental apartment buildings, industrial portfolio where we buy the bulk and sell the pieces, and land and density entitlement plays. We've learned that selecting the right partner is very important to have good alignment. And we've been very fortunate to have many strong partnerships. And I hope I haven't missed any groups here, but I'll name them. But with such groups as PC Urban, First Golf, Great Golf, Northbridge, Hopewell, Blackwood, Grosvenor, Anthem, Omicron, Lotus Pacific, Claria, Montoni, Port, Mission Group, Density, Pure Multifamily, and Townline. I'll be in trouble, Cam, if I've missed anybody, but great partners, and we couldn't do without their help in this fund. We also, as you can see, it takes up a lot of my time actually working with these partners too and staying close. So we also have benefited from some equity partners that have sometimes co-invested with us on some of these deals, such as Kingswood Capital and Northland Properties. They're local, and they've both been great to work with. So on the slide here, I've got just a sampling of some of the types of deals that we do in the value add merchant fund. So again, starting clockwise in the top left, this is Hudson Place 1. This was with Townline. This started construction before COVID, and then when COVID happened, the sales slowed down in Victoria, but then it gathered steam last summer, and I'm proud to say we're now 100% sold out. Even though it stalled a bit, it actually turned out to be a very good return for that project. Then in the middle, in the top is the Bertram. This is a condominium project with the Mission Group in Kelowna, right downtown, called the Bertram. It's 98% sold, pre-sold, and it's now under construction. This was very successful. And then in the top right is a property we bought on Granville Street called the Lex. It was an apartment building, but it was already had a condominiumized, so it was stratified. And so we bought it with our partner, the Pure Group, and we then executed on the strategy of selling out all the units. Some went to investors, some went to who kept the tenants, and others were the tenants who actually bought the units. So that's now 100% sold. Down on the bottom right, going clockwise, we This is the example of buying the bulk, selling the pieces. We bought the Fengate portfolio with First Gulf. We thought this would take 3 years. There was 9 properties. We're a year into it now. We bought it last year. We've already sold 8 of the 9. This is off the charts. This is higher return than we thought, and it's much quicker than we thought. So this is a really good outcome. Hard to find that today because the market's so picked over in Toronto, but we were just very fortunate on that. And in the middle, we've got the Evolution block, which is with PC Urban. And this is a 4-story building. Pretty cool. We've got number 1 collision on the ground floor, and then we thought we were going to stratify the 2nd, 3rd, and 4th floor to smaller tenants, but we ended up attracting a large life sciences tenant called P&I, Danaher, and they leased the whole building. So that is now completed and de-risked. And then last but not least, it is definitely my favorite asset type in the value add fund. And we think we're on to our 19th or 20th, and we've done many of them with PC Urban under the Interurban brand. This is in South Vancouver. I think we're on to our 12th or 14th project with PC Urban, and this one 100% pre-sold. It's under construction at record numbers that far beyond our performance. So again, Cam, we couldn't do this without the great work of our partners.
You mentioned earlier in this webinar the importance of the internal team, but as you said, critically important also to collaborate with best-in-class partners across the industry. Just a reminder for everyone, I can see some questions have been coming in about 9 minutes time. We will pivot to answering the questions you have sent through, and would encourage you to send questions through. We will get to as many as we can shortly. Lots of great momentum, Mark, some good news stories that you've pointed out. Looking ahead, do you see any threats in 2022 and beyond?
Yeah, being paranoid is not a bad thing. It keeps us from being complacent and getting too comfortable. So threats and speed bumps, they exist in any environment. Not many people anticipated that the economy would recover so quickly in 2021 on the heels of when COVID came out in 2020. And this included real estate, which rebounded much faster than we thought, as evidenced by our returns last year. But looking forward to 2022, we don't have our head in the sand. We know there's some threats on the horizon. And just, I've identified 6 on the screen here. So obviously, number 1 is inflation. This includes materials and labor. They're rising at an alarming pace. Interest rates, there's lots of talk about that in the media. We've been spoiled for the last number of years with a really record low interest rate environment. Interest rates are due to rise. Access to labor. I've never seen the development pipeline of new projects for all asset types this high. It's crazy how much is being planned or under construction. So access to skilled labor is an ongoing concern, and we need to do a better job at enticing these people into that field and provide job training. Supply chain. In the past, I think we've taken for granted the easy access to materials and product, and this is certainly being compromised as of late for a variety of reasons. Municipal government red tape. This is probably the most frustrating. The approvals for new build to own is particularly in Canada. It takes way too long for new build to own product. Something's got to change. We need a better system to get new supply to the market, and that's just not apartment buildings. It's industrial, it's office. I mean, we got record low vacancy rates, so we need to do a better job at getting approvals. And then lastly, federal government, not to get political, but this is probably the most disappointing from my perspective. We need better leadership for our country.
Your team has a mortgage group within it. We've had lots of discussion around interest rates. That team consists of 3 specialists to help manage and procure debt. Can you remind us of the key reasons why debt and the strategy around debt is so important?
Yeah. So Cam, you've probably heard me talk today about the team, and we've got our finance team, we've got our asset management team, and we've got our acquisition team, all very important. But we also have brought in some specialists, and I've talked about the leasing, I've talked about the development team, I've talked about the insurance, and now we also have a mortgage team. And you can imagine with our 3 funds now exceeding $6 billion in total asset value, there's a lot of debt you're dealing with. because our Nicola Wealth Real Estate team, we use debt responsibly to help produce attractive leverage returns for our investors. So with over 250 properties, there's a high volume of financing for land loans, construction loans, acquisition loans, renewals. There's a lot to do. And that's why we have a 3-person in-house team just to manage that portfolio. So while the procurement process, securing, the obvious primary business terms, such as interest rates, amortization, loan to value, while those are important, there's other considerations that we also focus on, such as covenants, insurance, reporting obligations. Those are all very important and what we focus on. Our high acquisition volume and track record has made us very attractive to financial institutions. It helps us negotiate favorable terms, and we go out of our way to get to know those lenders so they know who we are and where our capital comes from. Having these specialists on our team, it's essential to managing the high volume of mortgages to achieve these desirable outcomes for our clients. So with the anticipation of rising interest rates, what our team has been doing and is doing now is they're going on the offense to be defensive, to target many of our existing properties where, say we have 2 to 3 years remaining, and we've actually executed value add enhancements to those properties where we've benefited from net income growth through renewals or new leasing. So the team will then identify those properties and proceed to renew those mortgages 2 to 3 years in advance of the scheduled maturity as a hedge against inflation, and take advantage of the current low interest rate environment, and then recapitalize the asset, provided that we have an early, minimize the early penalty payout.
So a couple of questions to finish here before we turn it over to our audience questions. And these next two are somewhat interrelated, and I have seen questions coming in this regard. So ESG, which refers to the consideration of environmental, social, and governance issues, is gaining traction, and the requirement to have clear policy is growing. How is your team positioned in this regard, Mark?
My favorite topic. ESG it continues to gather momentum. It's not going away. And so for everybody's benefit, as Cam said, it's environmental, social, governance. And for large companies such as Nicola Wealth, this is a very high priority at all levels, and it trickles down to our 3 Nicola Wealth real estate funds. So we have a formal ESG policy. However, we are in the process of refining it to be more robust and in keeping with the ever-changing standards and measurements. So this will include all existing properties where we can implement changes to affect material, measurable energy and consumption savings. This will also apply to the new build-to-own projects where we can incorporate into the new projects energy savings, and you can make immediate impacts. So this slide that we have here, it's just a small portion of this is not our full policy. It's just an example under environmental, the E, the S, and the G.
As you had mentioned, careful consideration across all of our asset classes from an ESG perspective, and more to come for our clients in the future. Again, somewhat interrelated, climate change is in the news every day and seems to be more imminent and a serious concern as each season passes. How is this impacting strategy and decision-making on acquisitions and on our existing portfolio of assets?
So you can imagine this question comes in a lot from time to time from clients to our advisors down to us. Anytime there's a major event, they want to know if our assets are okay, and obviously that's why you have insurance. So there's no doubt that climate change is a major contributor to the rapid rise for insurance premiums. Insurance is a big issue for people who own real estate globally, and geography does impact our decision making and our acquisition process. However, each geographic community, it's impacted in different ways by climate, in one way or the other. And this could be storms, forest fires, flooding, or extreme heat. Since our last webinar in August, last summer, our last semi-annual, look what happened. We had a small town in BC recorded a record high temperature and it burnt to the ground. Or the atmospheric rains that hit Vancouver in Lower Mainland in November and flooded the Fraser Valley, causing immense destruction and suffering. I've never heard that term before. So the impact was severe, and it shut down transportation routes, and in the process, halting the supply of goods, including fuel, to Vancouver on it temporarily. So climate change is a serious concern. I don't know how you get around it, because it doesn't matter where you invest. I think one way or another, climate's going to affect that market.
So fairly simple question for you, Mark. Where should clients go to stay informed about our real estate funds?
Probably the best place is NicolaWealth.com, and I think the link is on the screen, and there is a section for real estate. We continually are updating our website to make it robust, but in the real estate section, and probably in the main website section, we have our quarterly reports, we have newsletters, we have podcasts, we have this webinar recording, and we have all our press releases on recent acquisitions.
So as promised, thank you, Mark. As promised, we've got almost 10 minutes to go through questions that have come in from our audience. And so the first one, I've seen several iterations of this question come through. What is your short to midterm view on real estate in Alberta?
It's interesting. 2 to 3 years ago, we got a lot of questions on Alberta, partly because the headlines were negative. Oil and gas, it was a one-horse town or one-horse province, and also that our allocation was over 30% in our Canadian fund. So fast forward to today, it's interesting, it really jumped out at me. Our allocation in Alberta is down to 14%, and it's not necessarily because we sold, it's because we've been so active in Ontario and like Toronto, Montreal, and Vancouver that it's just naturally brought down the allocation. Now, Alberta's been hit hard. It's had a double whammy. It's had COVID, and it's had the oil and gas and the economy. We're not afraid of Alberta. We like Alberta. We're going to be very measured and careful. We are still acquiring industrial in really strong nodes, because the industrial market actually is performing well. Same with multifamily. People are still living there. They still need a place to live. So we're not afraid of multifamily. I think the asset type that's probably been hit the hardest and will take probably a long time to recover is the office market, particularly in the downtown core.
You've mentioned, Mark, self-storage several times in this discussion. Why do you like self-storage? How did you get started, and what are your growth plans with the strategy?
I love self-storage because people will store $300 worth of their stuff, and they'll pay $1,200 a year. So there's a number of reasons why people want self-storage, and it's because as we build condos and rental apartments, and they're more smaller and efficient, they don't have as much space, so they need a place to put it. But it's also a part of our self-storage is commercial tenants. I would say, depending on the location, it could range from anywhere from 10 to 30% of the actual customers are commercial, where they're storing their goods. It could be the landscape guy or the pool guy, and they come there every day, get the materials, and they go out. But we're up to 9 self-storage right now in Canada, and we're on to 3 or 4 in the US. I mean, we like this asset class. It used to be considered an alternative asset class, and I think a lot of people are looking at it. The challenge is it's not like buying any of the other asset classes where you buy the real estate and you've got a tenant. This is actually an operating business. We have a very skilled management team that really deals with our staff engagement, customer service, and the brand through the website. So you need people to run that business, and we own the real estate, of course, but we love self-storage. We're going to continue to grow. You can continue to increase the rents. You're not subject to rent control. So yeah, it's definitely one of my favorite asset classes.
Looks like Minneapolis was a new market in the U.S. Are there any other U.S. markets that would be new that you're considering?
Yeah, so the U.S. is a very large market as opposed to Canada. So in Canada, you've only got certain choices. You've got Vancouver, Toronto, and Montreal, and after that, they're smaller markets. But the U.S. is very large. So we decided, let's not try and be everywhere. Let's try and pick cities that where we can get direct flights, or we can get that cluster strategy. So as I mentioned, we have 6 key cities that we're in that we really like a lot: Seattle, Denver, Phoenix, Vegas, Dallas, and Minneapolis. So we're building up a base, so we really have a strong presence in that market. It helps you in so many different ways. So we expect that we're going to be probably adding 1 or 2 for sure in the next year. And it could be Austin, it could be Reno. It's a very strong industrial market. Reno, even though it's smaller, it's very strong. Salt Lake City. So we're looking at these markets where they have great favorable tax environment, low vacancy rate, good education, strong employment growth. So that's what we look at. And before we go into any market, we do a bit of a deeper dive, and we do basically a business case and present it to our investment committee. And we get the green light before we jump in, and because we don't want to have just one asset in the city. You really want to have a critical mass to make it worth your while.
I'm guessing that your Nexus card is probably going to get some heavy use over the next 6 to 12 months. Probably time for 1 or 2 more questions here. So you mentioned life sciences earlier. What's your strategy on alternative asset classes such as data centers and life science buildings?
So those have been talked about a lot in the last 6 to 9 months. Data centers are I'll talk about that first. That's complicated because it is a very specialized use that actually requires a very heavy investment in the improvements. And with that, if we're providing that capital and that tenant fails, then you've got a building that's only suitable for data centers, which may be still in demand, but at very high rental rates. So there are data centers who are investing their own capital, so you provide the shell. They typically need to be where there's access to power. I wouldn't say we've ruled it out. We're watching it. We've been invited to look at a couple. So we're still examining those opportunities. I wouldn't be surprised if we did one, but there are some concerns about that because they're not as liquid and not as easy to lease if a tenant failed. With regards to life sciences, yeah, that's another very popular topic right now. And, you got that herd mentality with the institutional and the pension funds. They all want life sciences. Again, there's a heavy build out for those kind of uses, way higher than a typical office tenant. So if the tenant's putting in their own capital and you've got a normal rental rate, okay, fine. But we're not jumping in. We want to be careful that we're not buying a specialized building that is only suitable for that tenant. And if they fail or leave on expiry, we're stuck with a white elephant.
So I think time for one more, maybe Mark, in 75 seconds or less. It seems like there's been a large run-up in industrial values. Is your team concerned that the market has potentially peaked?
Yeah, the market has both land prices for industrial and cap rates and rental rates. It's way beyond anything we thought would happen. It is concerning. You wonder how much higher it can go, and can tenants afford to pay the rent? They're in shock. But it's still, when you look at it, probably a very small percentage of their overall balance sheet, so of their expenses. So they can afford it, but it's interesting how the vacancy rates have come down so low. So what we're watching very carefully is supply, because if the demand stops, that supply will go up, and that's going to cause rental rates to go down. And we're, markets that are very, very strong right now are the ones that we're in, but in particular in Canada, Vancouver and Toronto, I think their vacancy rate is almost zero. They're probably the 2 strongest industrial markets in the world. And the other markets in the U.S. that we like, and they also have low vacancy rates, are markets like, Vegas and Phoenix and Denver and the like.
With that, we are out of time. I know, Mark, we could probably have you talk for the next hour, 2 or 3. We'd probably still have questions coming in. We'll mention very briefly, we couldn't get to all of the questions. We do have an advisory team that is kept up to speed very effectively by Mark and his team. So we have a group that would be happy to connect. If you already have someone, feel free to reach out. If not, we certainly have people that can speak with you. Wanted to mention very quickly, our next webinar is our 2022 Strategic Outlook, hosted by our president, David Sung. It will feature presentations by John Nicola, who's our chairman and CEO, Rob Adel, our chief investment officer, Bijal Patel, who's our CFO and head of private capital, and our very own Mark Hanna. Our speakers will each weigh in on the issues influencing today's investing environment and how they impact their respective asset classes. So if you have interest in that, you can register by clicking the Register Now button to the bottom right of the screen, or you can visit our website. And Mark, a huge thanks for you for spending the time today. Also, a big thank you to our audience for joining us today. We hope you all have a great day. Thank you.
Thank you.